Duration-focused investing versus market timing. Most investors ask,
When should I enter?
fewer ask,
How long should I stay?
duration-focused investing shifts the primary variable from timing precision to time exposure. Instead of trying to predict short-term price movements, it maximizes time in productive assets. 1. The core difference. Market timing. Attempts to predict entry and exit points. Relies on short-term signals. Requires repeated accuracy. High behavioral stress. Duration-focused investing. Prioritizes time in the market. Emphasizes compounding. Reduces decision frequency. Focuses on long-term fundamentals. One depends on precision. The other depends on endurance. 2. Why timing is structurally difficult. Markets incorporate vast amounts of information quickly. To consistently time the market, an investor must be correct more often than the average participant. Act before information is fully priced in. Avoid emotional bias. Behavioral research by Daniel Kahneman shows that humans are prone to overconfidence, recency bias, loss aversion. These biases make timing errors frequent and costly. 3. Duration captures compounding. Duration-focused investing relies on the mathematics of compounding. As demonstrated by long-term investors like Warren Buffett, sustained exposure to productive assets allows returns to build upon returns over decades through Berkshire Hathaway's reinvestment strategy. Compounding requires capital, positive expected return, time. Without time, compounding cannot function. 4. Missing the best days problem. Historical market data consistently shows that a small number of trading days account for a large portion of long-term returns. Those days often occur near periods of extreme volatility. Timing strategies risk being out of the market during these critical days. Duration-focused investors remain exposed. Exposure, not precision, drives long-term growth. 5. Behavioral sustainability. Timing requires constant monitoring, emotional agility, frequent decision-making. Duration requires patience, rule adherence, emotional restraint. Simplicity improves adherence. Adherence improves long-term outcomes. The strategy you can follow consistently often outperforms the strategy that is theoretically superior but psychologically unsustainable. 6. Cost efficiency. Frequent timing attempts increase transaction costs, taxes, slippage. Duration-focused strategies reduce turnover, preserving more net return. As emphasized by John C. Bogle, founder of the Vanguard Group, minimizing costs is one of the few controllable advantages in investing. 7. Risk perspective. Timing tries to avoid downturns. Duration accepts downturns as part of the return structure. Over long horizons, economic growth, earnings expansion, productivity improvements tend to reward patient capital. Volatility is temporary. Compounding is cumulative. The strategic reframe. Instead of asking, "Is this the perfect moment?" ask, "Is this asset productive over the next 10 to 20 years? Can I stay invested through volatility? Does time increase the probability of success?" Duration changes the axis of decision-making. Final insight. Timing seeks control over short-term uncertainty. Duration harnesses long-term inevitabilities, growth, innovation, reinvestment. In competitive markets, precision is rare. Time, however, is available to anyone willing to use it. And in investing, exposure sustained over time is often more powerful than entry precision.